crude oil just crossed $115 a barrel. The Strait of Hormuz, the single most important waterway on planet Earth, is now effectively closed. 150 cargo ships are sitting outside its entrance, fully loaded, going nowhere. And somewhere in the halls of power in Riyadh and Beijing, two men are looking at each other and they are smiling. Because the war that America chose to fight has just handed them everything they ever wanted. The United States dollar, the foundation of the entire global financial system for the last 80 years, is under the most serious threat it has ever faced. Not from a missile, not from a bomb, but from a series of decisions made in the last 72 hours that no one in Washington seems to fully understand yet. Stay with me until the very end of this video because the final revelation is something that will genuinely change how you see the world. The end game is already in motion, and almost nobody is talking about it. To understand what is happening right now, you have to go back just a few days. Because what looked like a military operation, what the Pentagon called Operation Epic Fury, what the headlines described as surgical strikes on Iranian nuclear facilities, was actually the starting pistol for a chain of events that is now spiraling completely out of control. And the people who fired that starting pistol may not have fully understood what race they were actually starting. This is not a story about bombs and missiles. This is a story about the most consequential financial realignment since the end of the Second World War. And it is happening in real time, right now, while the cameras point at the explosions and miss the earthquake underneath. When the United States and Israel launched coordinated airstrikes against Iran, the stated goal was simple: eliminate the nuclear threat. Degrade Iran's military capability. Send a message to the region that there is a new sheriff in town and the rules of engagement have changed. The operation was described in Washington as a strategic success. Iranian radar installations destroyed. Command and control facilities taken out. Key elements of the nuclear program set back by years. The footage was dramatic. The press conferences were confident. The generals were composed, professional, and reassuring. And for about 48 hours, it looked like the hawks in Washington had been proven right. It looked like the operation had worked. It looked like Iran had been neutralized. But here's what the press conferences did not tell you. Here's what the satellite imagery and the triumphant generals on television completely glossed over. Iran did not respond the way everyone expected. Iran did not launch a wave of ballistic missiles at Tel Aviv. Iran did not send its air force into a suicidal confrontation with the most advanced military in the world. Iran did not do what it had done before, which was fire enough rockets to make a statement and then quietly wait for the diplomatic channels to open. Iran did something far more dangerous, far more calculated, and far more devastating to the long-term power of the United States than any missile strike could ever be. Iran closed the Strait of Hormuz. Now I need you to pause here and really understand what that sentence means. The Strait of Hormuz is not just a body of water, it is the jugular vein of the global economy. It is the single narrow channel, just 21 miles wide at its most narrow point, through which approximately 20% of all the oil consumed by the entire world passes every single day. Every day, 20%. That means 1 out of every 5 cars driving on the roads of Europe, Japan, South Korea, India, and Southeast Asia is running on fuel that came through that strait. Every flight, every factory, every power plant, every hospital generator across enormous swaths of the civilized world depends on oil that passes through those 21 miles of water. Every supertanker carrying Iraqi crude, every LNG carrier loaded with Qatari gas, every vessel hauling Saudi Arabian petroleum to the refineries of Asia and Europe, all of them transit through that narrow channel. And right now, it is closed. The Islamic Revolutionary Guard Corps, the IRGC, issued formal warnings to all commercial shipping that passage through the strait was no longer safe. They did not use those exact words, of course. They used the language of military operations. They spoke of security zones and exclusion areas and the right to enforce Iranian sovereignty over its territorial waters. But the message was unmistakable to every maritime professional who read it. Enter this water and face the consequences. Within hours, the insurance underwriters in London, who are the true gatekeepers of global shipping because no ship can sail without insurance, and no insurance company will cover a vessel operating in an active war zone, suspended coverage for vessels attempting to transit the strait. And when insurance disappears, shipping disappears. It is that simple and that brutal. Within 24 hours, the strait was effectively closed. Not because every ship was physically stopped by an IRGC gunboat, but because no rational captain, no rational shipping company, was willing to send a billion-dollar vessel and its crew into a war zone without insurance. 150 ships, sitting outside, waiting, each one of them carrying cargo that someone somewhere in the global economy desperately needs, each one of them costing its owners tens of thousands of dollars a day in port fees and crew costs and charter penalties. Each day that passes with those ships sitting still is a day that factories in Japan run short of feedstock. a day that refineries in South Korea operate below capacity, a day that power plants in India burn through their emergency reserves, a day that supply chains across the entire industrialized world grind just a little bit tighter. And while all of this was developing, while the world was watching the military headlines, something else was happening that the mainstream financial press completely missed in the chaos. The cost of this operation, what Washington called Operation Epic Fury, was bleeding America at a pace that the federal budget simply cannot sustain. Defense economists and independent analysts who were tracking the operational costs in real time came to a staggering conclusion. The first 100 hours of this operation cost the United States $3.7 billion. $3.7 billion in 100 hours. That is approximately $891 million per day. And here is the part that should make every American taxpayer's jaw drop. $3.5 billion of that $3.7 billion had not been budgeted. It was not in any congressional appropriation. It was not in any emergency supplemental that Congress had debated or voted on. It was not planned for in any fiscal year budget. The money simply did not exist in any authorized ledger. Think about what that means for a country that is already carrying a national debt of over $34 trillion. A country where every single political debate in Washington for the last decade has been about debt ceilings and fiscal cliffs and the unsustainability of federal spending. A country where politicians from both parties have given endless speeches about fiscal responsibility and generational debt and the obligation to leave a sound financial house for our children. That country just committed itself to spending nearly $900 million a day on a military operation with no defined exit strategy, no congressional authorization, and no budget. The bond markets noticed immediately. Treasury yields moved. Currency traders began adjusting their positions. And in Riyadh and Beijing, they were paying very, very close attention. But wait, because what Iran did next in the Strait of Hormuz is something that will change the world forever. And that is exactly where we are going right now. As the shipping freeze set in and oil prices began their vertical climb toward $115 a barrel, intelligence reports began filtering out of the region, with a detail that, when it became public, sent absolute shockwaves through the diplomatic and financial communities. Iran was not blocking everyone equally. Iran had made a quiet but unmistakable exception to its closure of the world's most important waterway. Chinese vessels, ships flying the flag of the People's Republic of China, or operating under Chinese commercial arrangements, were being allowed to pass. Not every ship, not openly and officially announced at a press conference. But the pattern was clear to anyone watching the maritime tracking data that shipping analysts and intelligence services use to monitor vessel movements in real time. Chinese tankers were moving through the strait. Everyone else was sitting still. Let that sink in for a moment. In the middle of a military confrontation with the United States and its allies, while the strait was officially closed to all commercial traffic, Iran had effectively handed China a monopoly over the flow of oil through the world's most important waterway. China, which already purchases the majority of its imported oil from the Gulf region, which already had deep financial and commercial relationships with Iran built over years of sanctions-busting trade, which had already signed a 25-year strategic cooperation agreement with Tehran worth hundreds of billions of dollars in investment and trade, now had something no other nation on earth had. Guaranteed access to Gulf oil in a time of global crisis. And what does guaranteed access to Gulf oil in a time of global crisis mean for the global energy market? It means that anyone who wants oil, and everyone wants oil right now, has to find a way to access it through Chinese supply chains. Or they go without. Now you might be thinking, okay, this is serious, but how does this connect to Saudi Arabia? How does this connect to the claim that Saudi Arabia and China just dealt the final blow to the US dollar? Because Saudi Arabia is supposed to be America's most important ally in the Middle East. Saudi Arabia is the country that, in the 1970s, agreed to price all of its oil exclusively in US dollars, creating the petrodollar system that has been the single most important structural support for American financial dominance for the last 50 years. Saudi Arabia is where American troops are stationed. Saudi Arabia is where the U.S. Air Force has bases. Saudi Arabia is the country that American presidents have made special trips to visit, that American defense contractors have sold hundreds of billions of dollars of weapons to, that American diplomats have defended in international forums through incident after incident that strained the relationship. Saudi Arabia was supposed to be the cornerstone of American power in the Middle East. So what changed? What happened in the last 72 hours that could possibly alter that relationship? What happened is that while American bombs were falling on Iran, Iranian drones were falling on Saudi Arabia. And that changed everything. The Ras Tanura oil refinery. If you are not familiar with that name, let me introduce you to it, because it matters enormously to understanding everything that follows. Ras Tanura is the crown jewel of Saudi Aramco's refining infrastructure. Located on the eastern coast of Saudi Arabia, right on the Persian Gulf, it is one of the largest petroleum refineries on the face of the earth. It processes millions of barrels of crude oil every single day. It is directly connected to the offshore oil fields that produce the lifeblood of the Saudi economy. It is the beating heart of the kingdom's export capacity. Every tanker that leaves Ras Tanura loaded with refined petroleum products is carrying a portion of the Saudi royal family's revenue, a portion of the government's budget, a portion of the salaries of the millions of Saudi workers and expatriate laborers who depend on oil money to sustain their livelihoods. And in the early hours of the same period that the world was watching as an American military triumph against Iran, Iranian drones targeted Ras Tanura, the Saudi air defense systems, the Patriot missile batteries that America had sold Riyadh and that American technicians helped maintain and operate, intercepted most of them, but not all of them. Debris from intercepted drones caused fires at the facility. Operations were halted, production was disrupted, and the message from Tehran to Riyadh was delivered with crystal clarity. You may think you are protected. You may think your American alliance and your Patriot batteries and your decades of cooperation with Washington make you untouchable, but we can reach your most critical infrastructure. And next time, we might not aim for the drones to be intercepted. For the Saudi leadership, this was a moment of profound and visceral reckoning. Here was the United States, the country that was supposed to be their protector, their security guarantor, the reason they had been pricing their oil in dollars for 50 years and recycling those petrodollars into American treasury bonds, fighting a war that had now brought Iranian fire to Saudi soil. American military operations had not protected Saudi Arabia from Iranian retaliation. American military operations had made Saudi Arabia a target. American military operations had shut down the Strait of Hormuz, which Saudi Arabia needs to be open in order to export its oil and sustain its economy. American military operations had caused a global oil price spike that, while superficially beneficial for a major producer, created enormous uncertainty and disrupted Saudi Aramco's ability to plan contracts, fulfill delivery obligations, and maintain the stable relationships with buyers that a national oil company depends on. And somewhere in the back rooms of the Saudi royal court, in the conversations that do not appear in official communiques, someone was asking a question that would have been essentially unthinkable 5 years ago. Is this alliance still worth it? Is the petrodollar relationship, the arrangement that has structured Saudi Arabia's place in the global economy for half a century, actually delivering the security and stability it was supposed to guarantee? And if it is not, what is the alternative? The Chinese had a very good answer ready, and they had been preparing it for years, because what is happening right now did not come out of nowhere. The seeds of this moment were planted deliberately, patiently, strategically by Beijing over more than a decade of methodical preparation. China had been watching the United States use the dollar as a geopolitical weapon for years and drawing very specific conclusions. Every time America imposed sanctions on a country, freezing their access to the dollar-denominated global financial system, they were demonstrating to every government in the world that dollar dependency was a vulnerability, not just a convenience. Every time America froze the foreign currency reserves of a sovereign government, as they did with Russia after the invasion of Ukraine, removing hundreds of billions of dollars in Russian state assets from circulation with a unilateral decision that required no international consensus, no treaty authority, no multilateral agreement, they were sending a message to every central bank on earth. If America can do this to Russia, they can do it to anyone. If you keep your reserves in dollars, you are not making a neutral financial decision. You're making a political bet that Washington will never decide to treat you the way they treated Moscow. China had spent years building the infrastructure for an alternative, the CIPS system, the cross-border interbank payment system, which is the Chinese equivalent of the SWIFT international banking messaging network that America had used as a lever against sanctioned countries. The digital Yuan, China's central bank digital currency, designed explicitly to facilitate cross-border trade and investment in a way that does not require routing through American correspondent banks or touching the dollar-denominated system at any point. Bilateral currency swap agreements with dozens of countries across Asia, Africa, and Latin America. Trade agreements denominated in yuan rather than dollars. Infrastructure investment programs through the Belt and Road Initiative that created deep economic dependencies and correspondingly deep political relationships with governments across the developing world. And most importantly, years of patient, respectful diplomacy with the Gulf states, arriving without political conditions, without lectures about governance or human rights, without threatening sanctions or regime change, and simply offering investment, technology, and the steady commercial relationship that wealthy Gulf monarchies have found increasingly difficult to sustain with Washington. So when the Ras Tanura refinery was hit, when the Strait of Hormuz closed, when Gulf leaders found themselves watching their economies being systematically damaged by a war that America chose to start without consulting them, without offering them advance warning, without securing their agreement that the timing was right or the strategy was sound, the the Chinese option suddenly transformed. It was no longer a long-term strategic hedge to be considered in theory. It was an immediate practical lifeline being offered by a partner who had been careful to maintain its relationships and who was now demonstrating, in the most tangible possible terms, that it could deliver what America could not. And then Qatar made the situation even more dramatic and even more economically consequential. Qatar is a tiny country, a narrow peninsula extending from the eastern coast of Saudi Arabia into the Persian Gulf, with a population of a few million people, most of them expatriate workers. But Qatar punches so far above its weight in global energy markets that it almost defies economic logic. Qatar sits atop one of the largest natural gas reserves on the planet. Its LNG export infrastructure, the liquefaction terminals at Ras Laffan, represents one of the most significant concentrations of energy export capacity anywhere in the world. Qatar has spent decades and hundreds of billions of dollars building the infrastructure to liquefy its natural gas, load it onto specialized tankers, and ship it to customers across Europe and Asia. It is responsible for approximately 20% of the entire global LNG market. 1 in 5 molecules of liquefied natural gas that heats European homes, powers Asian industries, and fuels the economic growth of dozens of countries passes through Qatar's export terminals. Qatar had actually been trying to play a constructive role in this crisis. Qatar had been the quiet intermediary, using its carefully cultivated relationships with multiple parties to try to facilitate ceasefire conversations, to keep diplomatic channels open, to prevent the conflict from escalating to the point where the global energy system was put at risk. Qatar had been making phone calls and hosting quiet meetings and doing the unglamorous but essential work of diplomacy. And then Iranian drones targeted Qatari LNG export facilities. And Qatar did the only thing it could rationally do. It shut down its LNG exports, it stopped loading tankers, it suspended the operations that represented the core of its national economic life. European nations that had spent years and enormous sums of money diversifying away from Russian natural gas after the Ukraine war, European governments that had signed long-term supply contracts with Qatar and invested in the LNG import infrastructure to receive those shipments, suddenly found themselves facing an energy supply gap they had no immediate way to fill. Gas prices in Europe began their own vertical climb. Germany, which had spent years fighting a painful transition away from Russian pipeline gas and thought it had finally secured its energy future through LNG diversification, was staring at a crisis. France, the Netherlands, Spain, Portugal, all of them scrambling to identify alternative supplies and coming up short. And who still had gas to sell? Who still had supply chains that were operational? Who still had tankers in the water and export infrastructure that was functioning? China and Russia, the two countries that the Western alliance had spent years trying to isolate and constrain, the two countries that had deepened their energy relationship with each other precisely because the Western sanctions pressure had pushed them together, the two countries that now found themselves in possession of the one commodity, energy supply, that the rest of the world was most desperately short of. And while all of this was unfolding in the energy markets and the shipping lanes, the global stock markets were delivering their own verdict on the situation. And it was not gentle. When the financial markets opened in Asia following the first 48 hours of Operation Epic Fury, the reaction was a stampede. Japan's Nikkei 225 index fell more than 7% in a single trading session. In dollar terms, that represents trillions of yen in market capitalization evaporating in hours. European markets opened sharply lower across the board. The DAX in Germany, the CAC in France, the FTSE in London, all of them down by multiple percentage points. Energy stocks spiked briefly because when oil goes to $115 a barrel, the major oil producers look attractive to investors for a moment. But every other sector of the global economy was bleeding. Airlines, because jet fuel had become catastrophically expensive overnight, and no airline can raise ticket prices fast enough to compensate for a sudden doubling of its fuel costs. Manufacturing companies, because energy is an input cost for literally every manufactured product on Earth. Retail and consumer goods companies, because their supply chains from Asian manufacturing hubs were disrupted and their transportation costs were exploding. And technology companies, because of something that deserves its own extended discussion. The Amazon Web Services data center in Dubai, this story did not receive anywhere near the attention it warranted in the cascade of military and energy headlines, but it represents something genuinely unprecedented. Amazon Web Services, one of the largest cloud computing platforms in human history, the infrastructure backbone for an enormous fraction of the global internet economy, lost a physical facility to what may be the first direct hit on a major Western commercial technology company's infrastructure in a conventional armed conflict. A fire broke out at the facility. Operations were disrupted. The databases and applications and services that ran on that infrastructure experienced outages. tens of thousands of businesses across dozens of countries that rely on AWS infrastructure for everything from their websites, to their internal systems, to their payment processing experience disruptions. And the message was sent to every technology company with Gulf infrastructure that your servers are not safe, your data centers are not protected, your billion-dollar investments in Gulf real estate and technology infrastructure are exposed to the same risks as an oil refinery or a military base. Now we need to get to what is perhaps the most seismic and most underreported element of this entire crisis. Because something explosive is happening inside Iran itself that matters enormously for understanding where this conflict goes next, and why a resolution may be far more difficult than anyone is currently acknowledging. The president of Iran, Masoud Pezeshkian, did something extraordinary. He apologized publicly to the neighboring states of the Gulf region. He issued formal statements expressing regret for the attacks on Gulf infrastructure. He acknowledged that Iranian military actions had caused damage and harm to neighboring countries that had no quarrel with Iran. And then he did something even more significant. He ordered the Iranian armed forces to cease strikes on Gulf countries. He used the authority of his office as president of the Islamic Republic to tell his own military to stop. The Islamic Revolutionary Guard Corps ignored him. The IRGC continued the attacks. The IRGC continued targeting Gulf energy infrastructure. The IRGC continued enforcing the Strait of Hormuz blockade according to its own strategic calculations rather than the wishes of the civilian government. And in doing so, the IRGC revealed something to the entire watching world that Iran's government had spent decades trying to conceal. The civilian government of Iran does not control the IRGC. The president of the Islamic Republic of Iran does not have real command authority over the Revolutionary Guard Corps in any meaningful operational sense. The IRGC is a state within a state. It has its own economy, its own foreign policy, its own military doctrine, and apparently its own decision-making authority that supersedes the elected president of the country when it comes to military operations. This creates an almost impossibly complicated situation for anyone trying to negotiate an end to this conflict. If you cannot negotiate with the president of Iran because the president of Iran cannot actually deliver on any agreement with the IRGC, who do you negotiate with? And if the answer is that you have to negotiate with the IRGC directly, an organization that has been formally designated a terrorist organization by the United States and that is deeply and ideologically committed to the destruction of American influence in the region, then what does a negotiated settlement actually look like? This is the trap that American policymakers walked into. This is the abyss they apparently looked into from the very beginning and chose not to fully reckon with before launching the operation. And into this vacuum of Iranian political dysfunction, into this moment of maximum regional instability, the American president decided to make a declaration that may prove to be the single most consequential statement of this entire crisis. Donald Trump publicly announced that he intends to play a direct role in selecting Iran's next supreme leader. He specifically identified Mojtaba Khamenei, the son of current supreme leader Ali Khamenei and the widely understood frontrunner to succeed his father, as an unacceptable choice. Trump made clear that Washington has decided that regime change in Iran is not merely a potential outcome to be managed. It is an explicit goal of American policy. Whatever your political views, take a step back from your preferences and think clinically about what that declaration means in practice. The leader of the world's largest economy has publicly stated that he intends to choose who leads another sovereign nation of 90 million people, not to defeat its military, not to impose a ceasefire, to choose its next leader. This is a statement that does not stay contained within the context of the Iran conflict. It reverberates through every capital in the world. In Moscow, in Beijing, in Delhi, in Ankara, in Jakarta, in Brasilia, every leader who heard that statement asked themselves the same question. If America will say this about Iran today, when might they say this about us tomorrow? And that question is doing more work for the Chinese geopolitical project than 1,000 diplomatic meetings could achieve. Because the single most powerful argument China has been making to the developing world is that China respects sovereignty and America does not. China does not tell you who your leader should be. China does not impose political conditions on its trade and investment relationships. China builds roads and ports and power plants and asks for business in return. And now the President of the United States has just handed Beijing the most powerful piece of evidence yet that this characterization is accurate. This matters for the dollar. Everything in this video matters for the dollar because dollar dominance is not solely about military power and economic size. It is about trust. It is about the belief held by central banks and sovereign wealth funds and corporate treasuries in every country on earth that the dollar is a neutral, stable, reliable medium of exchange that will be available to everyone on equal terms, regardless of their political relationship with Washington. Every time America uses the dollar as a weapon, Every time it freezes reserves, imposes financial sanctions, excludes countries from the dollar-denominated system for political reasons, it chips away at that belief. It demonstrates that the dollar is not neutral. It is a political instrument. And the revelation that it can be turned against you at any moment for any reason that Washington decides to call a national security interest is a revelation that changes the calculus of every financial decision maker who manages assets in dollars. Now, I want to take you directly into the conversation that is happening behind closed doors in Riyadh right now, because this is the conversation that has the potential to change the global financial system more profoundly than anything else in this entire crisis. The conversation is about oil pricing, about whether Saudi Arabia, the world's largest oil exporter, the country whose decision in the 1970s to price all of its oil in US dollars created the petrodollar system that has underpinned American financial dominance ever since, will begin accepting Chinese yuan as payment for its oil exports, not as a complete replacement for dollars, not as a dramatic public abandonment of the petrodollar, but as an additional option, a partial shift, a signal to the global financial market that the era of exclusive dollar pricing for Gulf oil is approaching its end. This is not a new idea in absolute terms. The discussions between Saudi Arabia and China about yuan-denominated oil contracts have been ongoing for years. Every few months, the rumors surface, the dollar dips slightly on the currency markets, and then the discussions seem to quiet down and the petrodollar survives another cycle. Western financial commentators have repeatedly declared these discussions to be more noise than signal, and perhaps, for most of the last decade, that assessment was correct. But the context right now is completely different from anything those discussions have taken place in before. For the first time, the United States has demonstrated in real time and in the most dramatic way possible that American military power cannot reliably protect Gulf states from Iranian retaliation. The Patriot batteries did not stop the Ras Tanura attack. The American carrier groups did not prevent the Strait of Hormuz closure. The American alliance did not provide Saudi Arabia with advance warning before launching an operation that made Saudi Arabia a target. American power, the power that Saudi Arabia has been paying for through petrodollar recycling and weapons purchases and diplomatic loyalty for 50 years, has delivered an outcome that is directly damaging to Saudi interests. The petrodollar system works like this, and understanding it is essential to understanding why this moment is so consequential. Saudi Arabia and the Gulf states sell oil. They sell it in dollars. Everyone who wants to buy that oil has to acquire dollars first, which creates global demand for dollars that keeps their value elevated. The Gulf states accumulate enormous dollar surpluses from these sales. They then recycle those surpluses back into the U.S. financial system, primarily by buying U.S. Treasury bonds and investing in American financial assets. This creates a permanent, structural, self-reinforcing global demand for both dollars and dollar-denominated assets. This demand keeps American interest rates lower than they would otherwise be. This demand allows the United States to run persistent current account deficits and fiscal deficits that no other country on earth could sustain without triggering a currency crisis. This is the structural privilege at the heart of American economic power. If Saudi Arabia begins pricing even a portion of its oil in yuan, the global financial implications compound in ways that are almost universally negative for American financial interests. The recycling mechanism weakens. Demand for Treasury bonds declines at the margin. Interest rates face upward pressure. The cost of servicing $34 trillion in national debt increases. The Federal Reserve faces a more constrained range of options in managing the economy. And the signal sent to every other oil exporter, every sovereign wealth fund, every central bank around the world that is already quietly diversifying away from dollar reserves is amplified enormously by a Saudi decision to move in this direction. That is what China is positioning for. That is what the passage of Chinese tankers through the closed Strait of Hormuz is really about. That is why the combination of factors in this crisis all point in the same financial direction. The global stock markets are reflecting the early stages of this repricing. When the Nikkei falls 7% in a day, it is not just a number on a screen. It is the collective expression of the investment community's dawning recognition that the rules of the global economic game may be changing faster than anyone anticipated. When insurance markets for Gulf shipping collapse overnight, it is not just a technical market disruption. It is the financial system's acknowledgement that the structures of risk and reliability that have been assumed for decades are no longer reliable. When sovereign wealth funds in Asia and the Middle East begin quietly shifting their reserve allocation away from dollar-denominated assets, which the data suggests has been happening gradually for years and is now accelerating, it is not just portfolio management. It is a vote of no confidence in the permanence of dollar dominance. Now here is what I want you to understand clearly and without exaggeration. The dollar is not going to collapse tomorrow. It is not going to collapse next month. The structural advantages of the dollar system are real and deeply embedded. The depth and liquidity of American financial markets, the strength and predictability of American legal institutions, the sheer size and dynamism of the American economy, the network effects of a system where everyone uses dollars because everyone uses dollars. These are genuine, substantial advantages that do not disappear because of a single crisis, however significant. What we are watching is not a collapse. What we are watching is the acceleration of a structural erosion that has been building for years, and that this crisis is now advancing by a decade or more in terms of its timeline. The question was never whether dollar dominance would eventually face serious competition from a multipolar currency system. The question was always about timing, about whether the transition would be gradual enough to be managed or sudden enough to be genuinely destabilizing. And the events of the last 72 hours have shifted that timeline in a direction that should concern every financial decision maker, every policymaker, and every individual whose economic life depends on the stability of the global financial system. The Gulf leaders understand this. The same leaders whose countries have been absorbing the collateral damage of Operation Epic Fury, whose oil infrastructure has been targeted, whose shipping lanes have been closed, whose economies have been disrupted, are now turning to Washington and pleading for a ceasefire. Not because they have suddenly become sympathetic to Iran, but because the war is destroying their economies in ways that cannot be sustained. The Strait of Hormuz being closed is not a temporary inconvenience for a Gulf oil exporter. It is an existential crisis. The LNG terminals being offline is not a market disruption. It is the suspension of a country's primary economic function. And these leaders are learning, in the most expensive possible way, that what America wants to achieve and what the Gulf states need to sustain their economies are no longer the same thing. The interests have diverged. The alliance is under more stress than at any point in its entire history. When alliances break under pressure, when longtime strategic partners begin reassessing their relationships, the transitions that follow are rarely clean and rarely confined to the narrow issue that triggered the reassessment. They open everything to renegotiation. They create space for competing powers to offer alternatives. And the competing power here, the one that has been patiently building its alternative architecture, investing in its relationships, developing its financial infrastructure, waiting for exactly this kind of moment, is ready. History has seen this before. The British pound was the reserve currency of the world in the first half of the 20th century. Britain did not choose to give up that privilege. It was taken from them, gradually and then suddenly, by the unsustainable costs of 2 world wars, by the collapse of the colonial economic system that had supported sterling's global role, by the rise of a larger and more dynamic economic power that was ready to offer the world a more stable financial anchor. The United States stepped into that role in 1945 from a position of overwhelming economic and military strength. The question now is whether the accumulation of American strategic miscalculations, financial overextension, and geopolitical alienation of allies is creating the conditions for a similar transition. Not an overnight replacement, but a gradual, structural shift toward a multipolar financial system in which the dollar is one important currency among several, rather than the unique, unchallenged global reserve. China may not be ready to have its currency serve the full functions of a global reserve currency today. The Yuan lacks the full convertibility, the deep capital markets, and the political trust that a true global reserve currency requires. But China is building those things, year by year, relationship by relationship, crisis by crisis. And today's crisis, the crisis that America created by launching Operation Epic Fury, the crisis that Iran used to advance Chinese interests by opening the strait selectively to Chinese ships, the crisis that is driving Gulf states to reconsider their decades-long strategic commitments, this crisis may be remembered as the moment when the transition from dollar unipolarity to multipolarity became genuinely irreversible. Not because a single dramatic decision was made, but because the accumulated weight of the situation made the old arrangement impossible to maintain, and the new arrangement, built patiently by China over years, suddenly available and attractive. So what does this mean for you? What does this mean for the ordinary person watching this video, paying their mortgage, filling their gas tank, saving for retirement? It means that energy prices are going to stay high for longer than the markets currently expect, because the Strait of Hormuz does not reopen quickly. Even if a ceasefire is announced tomorrow, the insurance markets do not come back online immediately. The shipping companies do not send their vessels back into a war zone the moment a ceasefire is declared. The reopening of the strait is a process that takes weeks or months. And during that entire time, oil stays elevated. Elevated oil means elevated gasoline. Elevated gasoline means elevated transportation costs. Elevated transportation costs mean elevated prices for almost everything you buy, because almost everything you buy was moved by a truck or a ship at some point in its journey from factory to your hands. It means that your retirement savings are more exposed to geopolitical risk than the standard portfolio advice assumes. Because the correlation between global stock markets and geopolitical stability is not linear. Markets can absorb a certain level of geopolitical tension, They have priced in a certain level of risk, but they have not fully priced in the scenario where the petrodollar system begins to crack. They have not fully priced in the scenario where Saudi Arabia starts accepting Yuan. They have not fully priced in the scenario where the Federal Reserve is forced to choose between inflation and recession, while simultaneously managing the consequences of a structural decline in dollar demand. If any of those scenarios begin to materialize, the repricing of global financial assets will be sharp, sudden, and deeply painful. This is the real story, not the airstrikes, not the drones, not the dramatic footage of explosions and scrambling fighter jets. The real story is the quiet, almost invisible, but absolutely fundamental shift in the global economic order that is being accelerated by this conflict. The real story is that America chose to fight a war, and while it was fighting, two of the most consequential nations on earth, Saudi Arabia and China, used the moment to deliver what may be the most significant blow to dollar dominance in the 8-decade history of the petrodollar system. The war in the Middle East will eventually end. Wars always do. Ceasefires will be negotiated. Boundaries will be redrawn. Reconstruction will begin. The world will breathe a sigh of relief, and the headlines will move on to the next crisis. But the financial architecture that is being dismantled right now, the trust that is being eroded right now, the alternative systems that are being built and tested right now, those do not go back to the way they were just because the shooting stops. The petrodollar was built over decades. Its replacement, if it comes, will also be built over decades. But every crisis, every miscalculation, every moment when American military power fails to deliver the protection it promised, and American diplomatic relationships fail to hold under pressure, accelerates that timeline. We are living through one of those moments. And unlike most moments, this one is visible in real time if you know where to look. Not in the explosions, in the currency markets, in the oil price, in the route of Chinese tankers through a closed strait, in the silence of Saudi officials who would normally be publicly reaffirming their American alliance, in the conversations happening behind closed doors about a future where oil can be sold for Yuan. America is fighting a war, and while it fights, the financial architecture of the world is being rearranged around it. That is the story. That is what is actually happening right now while the cameras focus on the airstrikes. Share this video with everyone you know who is watching the military headlines and missing the financial earthquake underneath them. Because understanding what is actually at stake here, not just for the Middle East, but for every economy on Earth, for every savings account and every mortgage and every retirement fund and every business that operates in the global economy, is not optional. It is the most important geopolitical and financial story of our lifetimes. And it is unfolding right now. Now let me walk you through the exact chain of cause and effect that is playing out across global financial markets, because understanding the sequence is the difference between seeing what is on the surface and seeing what is actually driving the global economy right now beneath it. When oil crosses $115 a barrel, the first order effect is obvious. Fuel becomes more expensive. But the second order and third order effects are where the real damage is done, and they are where most people's analysis stops too early. The second order effect is inflation. Not just fuel inflation, everything inflation. Because oil is not just what you put in your car. Oil is plastic. Oil is fertilizer. Oil is the energy that runs every factory, every warehouse, every logistics network, every cold storage facility that keeps food from spoiling. When oil spikes by 40 or 50% in a matter of days, the cost of producing and delivering everything in the global economy increases simultaneously. And that inflation does not hit everywhere at the same time. It arrives in waves, moving through supply chains, appearing in wholesale prices first, then manufacturer prices, then retail prices, over a period of weeks and months. By the time consumers see it on supermarket shelves or in their utility bills, the underlying driver has already been embedded in dozens of layers of supply chain costs. The third order effect is what happens to central banks when inflation spikes unexpectedly. Central banks, the Federal Reserve, the European Central Bank, the Bank of England, have spent the last several years fighting the inflation that came from pandemic-era spending. They had, most of them, declared relative victory, claiming that inflation was returning to target and that the aggressive interest rate cycle of the last few years was coming to an end. Many central banks had already begun cutting rates. Markets had priced in further rate cuts. Investors had positioned for a world where rates were coming down and the cost of borrowing was becoming more manageable. An oil shock of this magnitude blows all of that up. Suddenly, central banks are not looking at rate cuts. They are looking at whether they need to raise rates again to fight a new inflationary pulse that is coming directly from the energy market. And if they do raise rates, they are tightening financial conditions into an economy that is already being squeezed by high energy costs, disrupted supply chains, and cratering consumer confidence. They are choosing between fighting inflation and avoiding recession. And historically, when central banks are forced into that choice by an external shock rather than by their own policy mistakes, the outcomes are rarely clean. The fourth order effect is what happens to government finances. The United States, as we have discussed, is already spending $900 million a day on an unbudgeted military operation. If energy prices stay elevated, the already strained budgets of governments across the Western world face additional pressure. Energy subsidies, inflation-linked entitlement payments, the cost of running government buildings and government vehicles and military equipment, all of which runs on fuel. Every dollar of oil price increase adds costs to every government on earth. And for governments that are already carrying high debt loads and facing political resistance to further borrowing, those additional costs create genuine fiscal pressure. And the fifth order effect, the one that almost nobody is talking about yet, but that will be the dominant story in 6 months if this conflict persists, is what happens to the emerging market economies. The countries of the global south, the developing nations of Africa, Southeast Asia, and Latin America are the most exposed to an oil price shock of this magnitude. They tend to have weaker currencies, which means that oil, priced in dollars, becomes even more expensive in local currency terms when the dollar strengthens in a risk-off environment. They tend to have thinner foreign exchange reserves, which means they have less buffer against the kind of import cost shock that comes from elevated oil prices. They tend to have less sophisticated financial systems, which means the second and third order inflationary effects move through their economies faster and with less capacity to absorb them. And they tend to have less political stability, which means that economic shocks translate more quickly into social and political instability. The last time oil prices spiked to levels anywhere near these, there were food riots in multiple countries. There were governments that fell because their populations could not afford basic necessities. There were debt crises in countries that had borrowed in dollars and found themselves unable to service that debt when their export revenues collapsed and their import costs exploded simultaneously. And the world right now is more financially interconnected, more debt-laden, and more supply chain dependent than it was during any previous oil crisis. The vulnerabilities are larger. The buffers are thinner. The margin for error is smaller. All of this is why the conversation happening between Saudi Arabia and China matters so much. Because Saudi Arabia has the ability, if it chooses to exercise it, to take actions that would either accelerate or decelerate the pace of all these cascading effects. If Saudi Arabia maintains the Riyadh-Washington relationship and continues pricing oil exclusively in dollars and continues recycling petrodollars into American treasuries, it stabilizes the dollar, reduces the pace of financial fragmentation, and buys time for American policymakers to manage the consequences of the war. If Saudi Arabia begins the Yuan pivot, even partially, it removes a crucial stabilizing pillar from the dollar system at precisely the moment when the dollar is under the most pressure it has faced in decades. The timing could not be more consequential. And the timing is entirely in Saudi Arabia's hands. This is leverage that the Saudi Crown Prince Mohammed bin Salman understands intimately. Whatever else you may think about his leadership, he is a sophisticated political operator who understands that Saudi Arabia's financial relationship with the United States has always been a two-way arrangement. America provides security, Saudi Arabia provides petrodollar support. If the security side of the arrangement has just been demonstrated, publicly and dramatically, to be insufficient, then the financial side of the arrangement is logically subject to renegotiation. And the person sitting across the table from him, offering a renegotiation on very favorable terms, is China. A China that has never asked him to justify his domestic political decisions. A China that has never threatened to block arms sales over human rights concerns. A China that has never shown up with political conditions attached to commercial relationships. And a China that is, right now, the only major power whose tankers are moving through the Strait of Hormuz while everyone else is stuck outside. This is the final blow. Not a missile strike, not an army. Not an invasion or a coup or a dramatic military confrontation. A commercial decision, a pricing decision, a choice made in a boardroom or a palace somewhere between the dollar and the yuan. That is how reserve currencies fall. Not with a bang, but with a series of quiet commercial and financial decisions, made by rational actors responding to rational incentives that gradually redirect the flows of money and oil and credit that sustain the existing system. Britain's sterling did not collapse in a day. It eroded over decades of decisions that each made perfect sense in their own context, and that collectively dismantled the architecture of British financial supremacy. We may be watching the beginning of that same process for the dollar. Not its end, but its beginning. And the decisions made in the next few weeks, the way this war ends or does not end, the terms of any ceasefire, the post-war arrangements for Gulf security, the future of the Strait of Hormuz, the outcome of the Saudi-China oil pricing discussions, will shape the global financial landscape for the next generation. Pay attention, not just to the headlines, to the prices, to the patterns, to the quiet, steady accumulation of decisions that seem small in isolation and are enormous in aggregate. Because this is how the world actually changes. Not in the dramatic moments that make the front page, but in the accumulating weight of the moments that do not. And right now, in the energy markets and the currency markets and the shipping lanes and the back rooms of Gulf palaces, the weight is accumulating very, very fast. That is the story. Share it. Because the people who understand what is actually happening right now are not the ones watching the explosions on the news. They are the ones watching the oil price, the yuan, and the route of Chinese tankers through a closed strait. Now you are one of them. The world is changing. The question is not whether you will be affected by that change. The question is whether you will understand it in time to prepare for it. The people who understood that the dollar was replacing sterling in 1945 positioned themselves accordingly. The people who understood that oil was the foundation of global financial power in 1973 positioned themselves accordingly. The people who understand what is happening right now in this crisis, in these specific 72 hours that may prove to be the hinge point of the global financial order, are positioning themselves accordingly. The information is available to anyone who looks past the military headlines to the financial earthquake underneath. And now you have looked. Now you know. What you do with that knowledge is up to you.